Hello, smart investors, and welcome to For Fair Value Investing. Today's stock is TD Bank, which trades with the ticker name, yep, you've guessed it, TD. TD is the second largest bank in Canada, and it drives only 60% of its revenue from Canada. So you can say it's a little bit diversified when it comes to regional risks, although 35% of the remaining 40 comes from the United States. The stock is up 19% from its year's low on March 23. I don't know who bought stocks on March 23, but if you're one of them, please contact me because you're genius. Almost all stocks bottomed down on March 23. Anyways, it's down 24% from its year high on November 25. In the last year, TD dropped by 22%, lagging the S&P 500 index by 30%. And over the last 5 years, it depreciated by 8%, lagging the S&P 500 by 48%. Let's check out what happened under the hood. Not so bad. Revenue has been growing by an average of 6.5%. That's a decent number for a large bank like TD. Number of shares are flat as Saskatchewan. FYI, that's the flattest province in Canada. I mean, why would they want to raise capital by issuing shares? You're just voluntarily giving them free money, and they're paying you 0% interest. That's a wonderful business model. Earnings per share has been growing by an average of 8.7%. Dividends payout to investors has been increasing by an average of 9.5%. At least if you're banking with TD, buy their shares so that you can get benefit from them ripping you off. We're missing the fourth quarter for 2020, but using estimates for 2020 revenue has been grown by 1.7%. Why? Well, watch the news. And for 2021, revenue will be down 1.4% because the loans that are going to default are going to take effect after the government stops printing free money. You'll see. Analysts are so afraid to study bank stocks, so we only have 5 of them studying TD. We have 1 buy, 2 hold, and 2 sell ratings. Jokes aside, TD is the top issuer of credit cards in Canada, which is the most profitable business under normal economic conditions. So think of TD as a long-term investment. You can buy it now for cheap and will pay off after 2 or 3 years when we get out of this situation. Let's check out the fundamental indicators. Profitability score 6 with 9% earnings growth, 33% operating margin, 11% return on equity. By the way, if you put your money at any bank, you're getting 0% return on equity. That's why they have 28% profit margin. Well, that information is too complicated for banks and YouTube isn't paying me well enough, so I'm skipping that. Dividend score is 7 with 9% dividend growth over the past 5 years. By the way, TD is so-called dividend aristocrat, meaning they have consistently paid out and grown dividend for at least 5 consecutive years. And in the case of TD, that applies for pretty much the history of the company. Bottom line, your dividend payments are safe with TD, and with a nice 5.4% yield and 63% payout ratio. Well, to be fair, that's a bit higher than the previous years. And make sure to buy the stock before January 7 to be entitled for that dividend. Valuation 9. The stock is cheap. What can I say? Buy. Buy. See, I wasted a couple of hours to show you currently it's 23% undervalued. If Apple gave you 23% discount on an iPhone, you wouldn't think twice, would you? Yada. Last year earnings came 2.8% below analyst estimates. All those analysts didn't see the disasters coming in 2020. But now that they know, they're expecting $5.43 for next year, just slightly above this year's numbers. And with the current stock price, you're paying 11 times earnings. Do the math, I dare you. It's just like magic. 11 times 5.35, you get today's price. Alright. If earnings beat estimates for the next year, we might expect the price to reach 71. If earnings come up exactly as estimates, we might expect to see the price at 67. And the best part is, even if earnings disappoint, we should still see a higher price within the next year because the stock is cheap. It's cheap. So on average, the stock is expected to appreciate by 15%, and with the lower than expected earnings, the stock might still appreciate by 9%. And don't forget about the 5.4% dividend you'll get as well. And as always, before you invest into a stock, do your own research and feel comfortable in what you're investing in. Don't try to sue me, you won't find me, I'll live under a rock. Always diversify across multiple industries so you don't cry like a baby. I'll be posting a lot of companies with high expected returns, and as long as you trust the fundamentals of the business, do not panic sell or follow the herd and buy overvalued stocks that are meant to come down. Alright, that's it for today. Thanks for watching, and please like and subscribe to my channel and comment down below if there's a stock you're interested to invest in.